What is it? It's the Fed. That's the only central bank still exposed to a net short derivative book. And while this is transparently evident in the hard-to-hide COMEX futures market footprints, where we can tie auditable monthly Fed repayments back to the BIS, as we have in every single episode we've tracked, the Fed being actually forced to buy back their short-sold lease borrowings into a series of higher prices. Now, it's the larger over-the-counter naked short unallocated bets.
The gold market is entering one of its most critical turning points in modern history. Mounting evidence shows that the Federal Reserve has been caught on the wrong side of massive short gold derivative positions, forcing it to buy back leased gold at increasingly higher prices. This exposure, visible through COMEX footprints and BIS repayment trails, reveals the Fed's vulnerability to a global gold revaluation event. As Basel III reforms reshape market structure and physical demand from China surges, the old paper-based system of price control is breaking down. Global liquidity has shifted toward physical exchanges, such as the Shanghai Gold Exchange, where true price discovery is occurring beyond Western manipulation. AndrewMaguire, a veteran precious metals analyst and whistleblower with decades of experience uncovering manipulation in the gold market, explains how this unfolding dynamic could culminate in a formal U.S. Treasury gold revaluation. According to him, as the COMEX becomes a price taker rather than a price maker, the days of synthetic paper suppression are numbered. The imbalance between physical and paper gold has reached an unsustainable level, and that means gold's real price may soon be repriced dramatically higher. Now, we present the clips from AndrewMaguire's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
We'll drill into the detail of how vulnerable to a forced gold revaluation this presents the Fed. And we're going to do that shortly, but the far more visible COMEX futures positions. Now, this is the spot market. So let's look at the futures market, which is really apples to apple. Every single month, we evidence how deep a hole the Fed has dug. Now, this is best demonstrated by the sequentially higher end of month and now yesterday's here end of third quarter mark-to-market event. This time, despite a massive effort to rinse out as many spec longs as possible into yesterday's end of quarter, we saw an attempt to rinse out. So basically, to try and mark that down, the bottom line is the Fed was forced to buy back deeply underwater gold leases at exactly $409 per ounce higher than they could last month. Now, given there's still 30 tons to buy back at market, it will drive the offer price to sell gold even higher. So if I'm a seller, I'm going to, and I see this demand coming through, then I'm going to raise that price. It's the Fed that's on the hook for the remaining asymmetrically imbalanced short bets against gold, and having no physical bullion to back up those short bets, and having not anticipated that the COMEX has been forced to become a price taker, the only solution is to once again buy back this borrowed gold at the market price, ahead of an impossible to avoid gold price revaluation. And as we just evidenced, currently this will cost them over $400 an ounce, more than last month's BIS repayment. Following a good deal of healthy skepticism around our assertion that the Fed must revalue gold, it seems we're not alone anymore in assessing it for all the same reasons we previously outlined, as picked up for the first time here by Bloomberg on Monday, and also picked up by Zero Hedge alongside other mainstream media publications we're not going to bother to dig into at this point. As we summarized in our last episode, this relentless bricks gold demand has driven the legacy paper market into an impossible to maintain divergent inflection point that can only be resolved by one of two events: a massive bid only T+1 margin call, meaning it's got to be delivered right away. That can only be resolved. So either that way, and that's would spike gold, as we said last time, thousands of dollars higher, or of course, much more equitably resolved by a more orderly US Treasury gold price revaluation. Now that global physical exchanges have become sufficiently liquid to benchmark a real supply gold bullion price outside the CME LBMA ring fence, the stealthy gold revaluation process that commenced directly after the Bank of International Settlements revalued gold as a first-tier high-quality liquid asset on the 1st of January 2023 has gathered sufficient momentum to force the US Treasury gold to be revalued. There it is. You can start to see it. And as we've been drawing attention to, every single non-dollar denominated fiat gold price has led dollar denominated gold into all-time highs. So every other gold price in every other currency has been making new highs long before dollar price was dragged higher. But as we've been focusing on, the real game changer is that China took the gloves off the moment that yuan gold became fully Basel III compliant, followed by opening up Western-facing institutional-grade gold trading and vaulting facilities, which eliminate unallocated gold counterparty risk. Hey, no-brainer there. And with that in mind, and obviously you need the right liquidity to do that, but with that in mind, with the SGE market holiday coming up, now there is a market holiday and it starts today. Now, drilling down even further, illustrating the SGE has now overtaken Loco London as the global price setter, the relatively small 3 to 5 tons of Basel III compliant London spot gold that settles at the fixes is actually dwarfed by the 15 to 50 tons of SGE gold physically withdrawn every day. Now, recently, we've evidenced these volumes ramping up fast, hitting record volumes as high as 53 tons, entering warehouses at the end of the day. This gold is flowing into China at the expense of the legacy cartel. Now, these footprints illustrate that the SGE global bullion trading hubs have become sufficiently liquid to discover 2 competing institutional-grade Basel III compliant physical fixes. That's Beijing time 10:15 a.m. and 2:15 p.m. That enables the diluted Loco London twice daily fixes to be one-to-one arbitraged as a benchmark. Now, the clues are all there. Each Asia buys physical, COMEX sells paper session, and we see multiple examples of it. AM fix versus a PM fix. Now, we have seen some change in behavior, but usually it is Asia buys and the West sells. And again, we've seen, although we see a break in behavior here, it's simply because the shorts got squeezed more than they could cope with. And again, we see a new high being made today, Wednesday, and then the PM fix coming in lower. All that does is set up China for an Asia to set up a bid-only situation, which we saw after the sell-off. Okay, so China's on holiday, but the PBOC certainly is not. And as I say, ETF demand will not stop. It's only just begun. Now, let's look at why CME margins, meaning the cost to borrow 100 ounces of a gold contract from the house, currently is $17,000 per contract. Now let's look at why they have not raised these margins from a value of 280,000, which is 6.07% of the value of 280,000, and why, and I haven't even marked the latest highs here. I just recorded this yesterday. That was 390,000 per contract value, and the CME margin was still only 17,000, which is only 4.3% of the value. Now that raises the question, why have the CME, essentially, why has the CME not raised gold borrowing margins into the subsequent, now bearing in mind that we talked about how speculators buy and you want to knock them back down. You want to take the with impunity, add short positions against them and then raise the margins, and they're so leveraged, they simply have to sell. Beggars the question, what's different now? So the Post-Basel III gold first-tier reclassification on the 1st of January 2023 had driven a 970 rally from 1830 into the 1st of November 2024 at 2800, prompting the CME to raise GC borrowing margins on that day. And this margin increase, as I say, targeted heavily leveraged longs who'd borrowed gold from the controlling COMEX cartel, triggering a 2-week $260 sell-off. As I say, why has it not raised since? Because you're talking a $1,300 gold price appreciation, which just this week has just tagged pretty close to just over 3,900, lowering the cost to control 390,000 of positions to just 4.3%. Now, to put that into context, these unallocated GC contracts, gold futures contracts, are currently leveraged at a massive 96 ounces of paper to 1 ounce of gold. The answer is simple. While gold was equally overbought, and look, it was equally overbought back in November 2024, there was still sufficient heavily leveraged speculator open interest for the house to target to short cover these one-to-one shorts they'd placed against these specs. However, now it's the legacy shorts that are vulnerable. Hence, against all the pressure to raise margins, the house has resisted raising them. Given the pressure that this is so blatant and there are questions, so it may happen, but net of the current healthy long stop rinses, if you raise them now, the longs have a lot of ability to absorb a margin call because they've got a lot of padding under their positions. It's the shorts that would be vulnerable to a small rise in borrowing costs, as it would really literally force them to short cover. Shorts are stretched.
Silver is entering a historic phase of structural repricing as the COMEX, once the global benchmark for precious metals, is now forced into a price-taker role. Despite record volatility and escalating demand, silver futures margins remain unchanged, a move designed to protect the prominent naked short positions still held against the silver market. However, with global supply tightening and the metal recently reclassified as a critical mineral, Russia, China, and now the US are all accumulating silver at unprecedented rates, while geopolitical tensions and looming export bans further strain the market. The physical silver shortage is beginning to expose the limits of the paper market. Dollar-denominated silver remains artificially underpriced compared to record highs in other currencies, mainly due to China's aggressive stockpiling. As Western institutions re-enter the market, fresh demand is absorbing every dip, pushing spot and futures contracts toward multi-decade highs. The latest figures show over 370 tons of non-delivery October silver contracts now being called for physical settlement. With the Fed caught short and no physical metal to deliver, the setup for a violent upward revaluation grows stronger by the day. Let's get back to the interview.
For all the same reasons, silver futures margins have not been raised to protect the very large naked officially short bets against silver. Now, with COMEX now reduced to becoming this price taker, the only solution to buy this silver back at market is to buy it back at market. But hey, Houston, there's a problem. Isn't that a saying? Houston, there's a problem. Silver has just been classified or reclassified as a critical mineral. Now, into really very, very escalating geopolitical and tariff escalations, it's in very strong Russian and Chinese military demand. Now it's in US demand. I mean, basically, that's why we're noting record prices in every single global foreign exchange, prompting the US to both accumulate and the word is soon to ban exports of US silver. There's only one outcome to tightening supply. The offer to sell silver for immediate delivery is simply going to rise. Let's look at a similar look at the silver futures structure. For all the same reasons, they haven't raised margin calls. And you think about it. Take a look at this, which is a protection of very large, naked, official short bets against silver. And with COMEX now reduced to becoming a price taker, the only solution is to buy this silver back at market. As I say, here's the problem. And as we just noticed, silver's just been reclassified as a critical mineral. And with it in accumulation with Russia, China, and the US has just begun, probably likely this export ban is almost certain. As I say, there's only one outcome to tightening supply. The offer to sell silver for immediate delivery simply has to rise. So, at a contract value of 165,000, and this was the same period, 2020, when they raised margins on silver to 16,000. Again, we saw a bit of a smackdown there. That was 9.7% of the 165,000. It's still 16,000, and we've actually moved higher now. So basically, even though it's slightly higher now, there's still 6.7% of contract value, which is a hell of a lot less. Now, shorter term, as silver broke out above the identified short stops at 44,275, if you remember, we circled this. I've now added color to that circle, but this is where the circle is, as is this circle at 53. But essentially, it broke out last Thursday. Then we saw UBS belatedly updating their silver spot price to between 44 and 47 per ounce, stating it would bring it in line with their upgraded 3,900 gold forecast made a couple of weeks ago. They also reaffirmed their intention to stay long and would view all pullbacks as buying opportunities. Interestingly, while they listed all the usual geopolitical industrial tailwinds, fiscal deficit and de-dollarization drivers, the pivotal critical mineral reclassification, and the G7-driven global stockpiling agreements were completely missed. Also, G7 began to weigh in price floors for counter China's dominance. So in summary, what this means is that dollar price silver is grossly underpriced versus at the highs in every other currency, led by daily fresh XAG CNY. In other words, silver against the CNY cross, the Chinese cross. It's being driven by Chinese physical stock. And you can see that this is where it's being led from. So silver price floors are being put in place with CME LBMA diluted dollar price silver in the crosshairs for delivery. Now, the consolidative long stop rinsing in silver is healthy, as it takes out low-hanging layers of cell ignition, like people who've borrowed silver from the house, and they've borrowed just about enough to create some cell ignition, but really it's very low-hanging because there's very little of it. Also, everyone is aware of the Fed wrong footing and are once again looking to capitalize on any dips that are offered. Now, following meetings with our Chinese-facing liquidity providers, they report fresh Western institutional gold and notably very large silver demand following the end of session. We saw a pit close. We saw a bid pulled sell-off in illiquid conditions. And so there was a dip below 46. And we knew these dips would be short-lived, sure enough. So the spot silver dip, I say dip, bid pull dip, sub 46 spot into the month and quarter end yesterday. Now, bearing in mind that 46 spot is roughly 46.17 in futures. So this futures trading around 17 cents higher. So, but that dip triggered enormous buying. It was readily bought, jumped on by Asian buyers overnight, and it drove another high, which was again sold into the London Open and again bought by Asian buyers. And what that did was overnight, and we're talking about Wednesday morning now, it drove another 2011, basically another 2011 high, which is actually the highest print since the all-time high. It was actually 48 and change in spot, but 49,820 in futures. Adding fuel to the fire, silver, that's the silver in CNH, which is essentially Chinese silver, is in massive demand, leading every other silver foreign exchange cross to all-time highs, euro, in every other foreign exchange cross. And given prices being discovered outside the CME LBMA ring fence, there's little doubt underpriced dollar price silver will exceed all-time highs. A lot of sideline money has come into play looking for cheap, underpriced dollar silver, price silver, notably adding fuel to the fire, followed a large 370 tons of so-called non-delivery October contracts being called for physical delivery. And there's still 82 tons of non-delivery October silver that has to be loaded out the back door. And while we did expect this fight at 44,275, last line of defense, the liquidity providers indicated physical supply is so tight, resistance would be short-lived, as short covering layers would be uncovered. And that's exactly what's going on now. Net of hedging supply, there is sufficient short covering fuel to drive a run into the next staging point of $53. So summing up, looking at gold as well, to see, it helps us to establish where the underlying paper market gold support is being disciplined. Following 20 consecutive fixes above 3,600 and then 10 consecutive fixes above 2,700. And now based on today's 4 consecutive fixes above 3,800, this constructive action is once again raising the physical support steps into another higher rally stair-step point. Each one of these levels were physically supported. Now, the spot silver dip sub $46, that's spot, into month and quarter end yesterday. We're recording this on Wednesday, and that was into the month end. And bearing in mind, silver is also a component of the OCC bets, which sit on the Fed's, in the Fed's hands. Nobody is short silver at this point other than the Fed. And guess what? They have no silver at all to actually repay this.
The evidence now points to a clear shift. Silver is no longer just an industrial metal or investment hedge. It's becoming a strategic asset in a world of tightening supply and geopolitical competition. With COMEX positions stretched and the Fed's paper shorts increasingly exposed, physical silver is asserting its dominance as a form of real money. As global stockpiling accelerates and export restrictions loom, a revaluation is no longer a distant theory. It's a process already unfolding quietly, in real time. This transformation isn't about speculative hype, it's about structural change. The market is revealing who holds real value and who holds paper promises. The institutions that once suppressed silver prices are now being forced to cover into strength, setting the stage for a powerful repricing cycle that could redefine the metal's role in global finance. Share your thoughts on their analysis in the comment section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.